Inflation has been a very important issue for our economy not just now, but since the last many decades, and more so importantly, even since our independence. India has seen inflation levels, at least in the last decade, under the bracket of 4% plus minus 2%. However, there have been few months and stretches of few periods where inflation has crossed the 6% mark as well, amounting to very high levels of inflation in the economy. Especially during COVID-19 times or COVID pandemic times, inflation could be witnessed in some very crucial sectors, especially in the pharmaceutical sector of our economy, because of the COVID-19 imposed lockdown. Now, one thing is very clear, that because of inflation over the last many decades and last many years, our money has lost its value. The amount of goods and services which a 100 rupee note could have bought 10 years back is not the same now. Today, for the same 100 rupees, I can get much lesser amount of goods and services. So that means the value of money has gone down over a period of time. Now, question is, what is inflation? How inflation is calculated, how it can be controlled, and what are the frameworks in place in India to combat inflation and to control and tame inflation? And is inflation good or bad? All these things we'll be trying to understand in this particular session. Hello everyone, you're watching Perspective. My name is Preetpal Singh, and today's topic is inflation, a necessary evil. Now, first, let us know what is this concept of inflation.
Inflation ticked up slightly year over year in October. The Consumer Price Index rose 0.2% last month. It is one of the key inflation gauges.
Inflation ticked back up in October, which is what economists were expecting.
News about prices in the grocery store.
Historically high inflation.
Now, the word inflation comes up from a Latin word that is inflare, which means to blow up or puff up. Now, inflation in very simple words means a steady and sustained increase or rise in prices of goods and services in an economy. Now, two words are very crucial here. One is the word steady and one is the word sustained. If we remove these two things, then it would be temporary fluctuations. And mind you, temporary fluctuations or short-term fluctuations in price or short-term increase in price does not amount to inflation. For inflation to exist, steady and sustained increase in price should and definitely should be there. Now, index means that there is a basket of different variables, and we use the basket to measure the increase or decrease in the prices of that basket. So whatever the changes happens in the overall average price of the basket, we monitor that, and eventually we are able to monitor the increase or decrease in the average price in the economy. Now, we are using the index, and what is that index called? That index is price index, since we are monitoring the price of the basket of goods and services in that particular index. So essentially what do is we take all the goods and services which are there, the most important ones, let's say food, let's say fuel, essential commodities, what we eat daily, and all those other things, we put all these things under a single basket. Now, once all these things are put under one basket, we get an average price of that basket, and we see that over a period of time, the average price of the basket is going upwards or downwards. And if it's going upwards, that means there is inflation. Now, how much percentage points it is going upwards, we get the inflation percentage value. Now, these price indexes, on the way they are measured, can be of two very prominent types. One is Consumer Price Index, another is Wholesale Price Index. Now, the difference is very simple and very clear. If we see the increase in price of goods and services from the perspective of a consumer, that is from the perspective of a retail buyer, then we are seeing the Consumer Price Index. However, when we see the increase in price of goods from the perspective of wholesalers, that means when they are purchasing goods at bulk, we are seeing the Wholesale Price Index. So it depends on from whose perspective we are seeing inflation. If we are seeing inflation from the perspective of retailers, that is retail buyers, that is Consumer Price Index. And if we see it from the perspective of wholesalers, those who trade in bulk goods, we see it from the perspective of Wholesale Price Index. And one thing is very important, that in Wholesale Price Index, only goods are taken into account, not services. And the base year for All India Wholesale Price Index is the year 2011-2012. And base year for consumer price index in our country is the year 2012. This consumer price index is calculated by the National Statistical Office under the Ministry of Statistics and Program Implementation, that is MOSPI. And further, this consumer price index is divided into 4 different types based on whose perspective we are calculating consumer price index. So based on different population groups, we have further divided consumer price index as well. That is consumer price index for industrial workers, consumer price index for rural laborers, consumer price index for agricultural laborers, and consumer price index for rural, urban, and combined. So all these 4 different types tells us that for each population segment, how much increase in price of goods and services has been there in a stipulated period of time. Now, since we are clear with how do we calculate inflation, one very important question which we need to address here is that why there is inflation at all in the economy? Why inflation exists? And the answer is very clear. See, population is increasing rapidly, and because of population explosion, alongside the resources on the other side, they are scarce, they're having limited uses. However, on the other hand, there are unlimited wants. So that means anywhere, if demand is more than the supply, the prices are going to go up, because people would be willing to pay more and more for that limited supply of goods and services. Now that is philosophical, but if you see really in the economy, why does inflation exist? One very logical reason can be increase in money supply. That means if there is increase in the money, disposable income, and the money available with the public would be tempted to spend more and more. And if people are tempted to spend more, that means they are willing to pay more. Their paying capacity has increased, and because of that, the sellers are tempted to raise their prices upwards. And because of that, over a period of time, inflation continues and inflation happens. Now, usually we classify the reasons of why inflation is there into 2 types. One is cost push inflation, and another is demand pull inflation. In one place, increase in demand is pulling the inflation upwards, pulling the prices upwards. And on other hand, increase in cost, which can be due to any disruption, which can be due to any war, supply chain malfunctioning. For example, we saw it during the COVID-19 period of time, or for a matter of fact, Russia-Ukraine war, or for a matter of fact, Israel-Iran issue. In these time periods or in these instances, we saw cost being pushed upwards because of supply chain shocks. So if supply is reduced and supply is basically tampered with, cost goes up. And if cost goes up, again, sellers will increase the price. So amongst all these scenarios, we can see inflation being existing in the economy. We've classified under 2 types, cost push and demand pull inflation. But the real question here is that if inflation exists in the economy, what does the government do to combat and control the inflation levels? See, controlling the inflation is not just the responsibility of the government of India. There are 2 very prominent organizations. One is the government, another is the central bank of the country. In our case, it is the Reserve Bank of India. So the economic policy of the government is the fiscal policy. Economic policy of the Reserve Bank of India is monetary policy. So both these policies, they work hand in hand in order to ensure that inflation levels are controlled in the economy. But again, you might ask a very logical question, that why there is a need to control the inflation? Is inflation good or bad? And if it is good, then how much it is good? If it is bad, then how much of inflation is bad? That is the question which we need to ask first before we go on to how to control inflation. So the answer is very simple. Inflation is both good and bad. Inflation at moderate levels. And now your question would be, how much moderate? See, it varies from country to country. In our country's perspective, inflation level upwards of 4% plus minus 2. That means 6% to 2% inflation is good and healthy for our economy. If inflation is lesser than that, it is bad. If inflation goes beyond the 6% level, then again it is bad. So it varies from economy to economy. For US, the level is a bit lower. For some other country, the level might be a bit higher. It depends on the economic conditions of the country. But inflation is both good or bad. If inflation is there in moderate amount, it is good. But the question is why it is good. See, because inflation indicates higher economic growth. If inflation is happening because of increase in demand, that means people are having more disposable income. And people are having more disposable income, that means economy is bound to grow. So certain percentage of inflation is essential for economic growth. That means it's essential for GDP growth as well. So certain moderate level of inflation is required. But if inflation surpasses certain level, that means beyond 6%, that means now the common public of the country is going to bear the brunt of increase in prices. So who will be the most impacted? The poor sections of the society, the underprivileged, the deprived section of the society will be impacted if the prices go beyond a control, beyond any controllable levels. So inflation, if tamed, if controlled, is good. Inflation, if it goes beyond the controllable levels, if it is uncontrolled, it is very bad for the economy. More bad for the poor and deprived sections of the society. So by answering this question, one thing is clear, that the motive of the government and central bank should be to keep inflation in that band, that is 4% plus minus 2. And to do that, what is government and Central Bank of India doing? For that, we have to understand the fiscal policy and the monetary policy. Let's start with the fiscal policy of the government. Now, fiscal policy is essentially having two important instruments. First instrument is taxes. Second instrument are subsidies. Now, let's say inflation is high and the government wants to combat inflation. In that case, what will they do with the taxes? Now, the first thing which we need to think here is that if inflation is there, that means money supply would be high. And if the government has the ability and has the authority over taxes, and government wants to reduce the money supply to combat inflation, government will increase tax or decrease tax? Definitely the government will go for increasing the taxes. So what does government do? Government increases the taxes. Increase in taxes leads to lower money availability with the public. If lower money availability with the public is there, people won't be able to spend. If people won't be able to spend, inflation automatically will come down, because people's ability to purchase, their purchasing capacity would lower down. So to control inflation, high levels of inflation, taxes are increased. But on the other hand, if there is a deflation, that means very less level of inflation, less than 2%, and we want to gain momentum in inflation, then we want more money to be with the public so that their purchasing power increases. In that case, will we increase tax or decrease tax? Definitely we will decrease the tax levels. So once we decrease the taxes, money available with the public increases. Their propensity to consume, their propensity to spend, it will increase. Because of that, inflation would be again back at the normal level, higher than before. So that is how taxes work. Second is with the subsidies. Now let's take subsidies for an instance. If the government is giving more subsidies, people are having more money, so inflation would be higher. So if the government wants to control high inflation, subsidies will go up or down. Government will reduce the level of subsidies. If the government reduces the level of subsidies, money available with the public will go down. The purchasing power of the public will go down. And if that goes down, inflation will be controlled. Now, on the other hand, if there is less level of inflation, government wants it at a moderate level. If it's 1%, government wants at least 4% inflation should be there, because that is healthy for the economy. It reflects economic growth. In that case, government will increase the subsidy or decrease the subsidy. Definitely government will increase the subsidy. Increasing the subsidy means more money with the public. More money with the public means higher purchasing power. Higher purchasing power means higher levels of inflation in the economy. So in taxes and subsidies, government goes in this way. And by this, government ensures that inflation level in the economy is controlled, tamed, and maintained at certain points. Now coming to the monetary policy. Now, monetary policy is very expansive and is a very elaborate topic. But for you to understand in a very simple way, we will briefly go through monetary policy. Now, monetary policy is consisting of two very prominent instruments. One is quantitative instruments and another is qualitative instruments. Let's first start with the quantitative instruments. Now, in quantitative instruments, there are two very prominent things. First are the rates. Second are the ratios. Now let's start with the rates first. Now under rates, there are two types of rates. One is repo rate, another is bank rate. One and the same thing, but in repo rate, there is collateral which is required. In bank rate, there is no collateral required. But the question is, what is this repo rate? Now repo rate is the rate at which central bank lends money to the commercial bank. Now you relate it with the money supply. Now let's say central bank is lending money to the commercial bank and then commercial bank is lending money to the public. So repo rate decides in a way the rate at which commercial bank is going to lend money to the public. So if repo rate of a country is increased by the Reserve Bank of India, that means credit for the public, the eventual public will also increase. The credit cost, that is the cost of borrowing, the rate of interest which the commercial banks will be charging from the public for loans, that is going to go up. Now let's say if loans in a country become expensive because of increase in repo rate, what will happen? People would be having more money or less money? Definitely people would be having less money because credit has now become expensive. Loans are now very, very expensive. If people are having less money, definitely it will help in combating higher levels of inflation. So that means if inflation is high, what do we do with the repo rate? We increase the repo rate. So central bank of the country will increase the repo rate to combat higher levels of inflation. And let's say if it is the opposite, if there is less levels of inflation, 1-2%, and the central bank wants it to go to at least 4-5%, what will central bank do? It will reduce the repo rate. That is the rate at which central bank lends money to the commercial banks. It will reduce the rate. Commercial bank in turn will reduce their lending rate. It will eventually reduce down the cost of borrowing. If that is reduced, eventually what will be ensured is more money with the public. And if people are having more money, their propensity to consume and propensity to spend will increase. They will be purchasing more and more. Their purchasing power will go up. They will be wanting to pay more and more for goods and services. That will take the prices higher. So to cure low levels of inflation and to increase the levels of inflation, repo rate will be decreased by the central bank. That is with the rates. Second is with the ratios. Now, two ratios are prominent. One is cash reserve ratio. Another is statutory liquidity ratio. Now, cash reserve ratio refers to the percentage of reserves which the commercial banks needs to keep with the central bank of the country, and that too with the RBI. So that means the proportion of reserves which the commercial banks needs to maintain with the RBI. Let's say all the deposits with the commercial banks are 100 rupees. And central bank says that those 100 rupees you can't lend fully. You need to keep certain percentage with me as reserves also. Let's say 4.5%. So 4.5% of that 100 rupees will be kept as reserves with the RBI. And that is cash reserve ratio. How much percentage of the total deposits you will keep with the RBI. Another is statutory liquidity ratio. That means the percentage of liquid assets which the commercial banks needs to maintain with themselves. So if the commercial banks, let's say 18%, it is required for the commercial bank to keep the total deposits percentage of 18% with themselves as reserves. That means you can't lend it. You keep it as reserves for day-to-day operations. That is statutory liquidity ratio. And what kind of liquid assets can be there? It can be either cash, it can be either gold, or it can be other governmental securities as well. But mind you, cash reserve ratio, the cash reserves needs to be kept with the RBI. Statutory liquidity ratio, the liquid assets needs to be kept with the commercial banks themselves. Now let's see how it is related to inflation. Now, what if inflation in the country is very, very high? And through ratios, the central bank wants to control it. That means through reserves. Now, one thing we are very clear with, if 100 rupees is there with the commercial bank, and if 20 rupees they keep as reserves, that means the remaining 80 they will be lending to the public. Now, what if the central bank comes and says that you increase the level of reserves? So that means if the central bank comes and says that from 20 you increase the reserves to 40 or 50, then if the reserves are increased to 40, let's say, the commercial bank will only have 60 rupees to lend to the public. In that case, if reserve requirement, if CRR or SLR is increased by the Reserve Bank of India, that means low loans to the public or lesser loans to the public. Lesser loans to the public, that means less money with the people. Less money with the people, that means low purchasing power, which will combat increasing inflation, which will reduce the level of inflation. And if we want to increase the level of inflation, if there is very less level of inflation, we want to increase it, we reverse it. That means if we are increasing the reserves to combat high levels of inflation, we will reduce the reserves to combat low levels of inflation and to make it a bit higher. I hope you are getting it. Now, prominently, we have discussed two very important components of this quantitative instruments. There are qualitative instruments as well. One very important qualitative instrument is margin requirement. That means the difference between the value of collateral and the value of loan. Now, collateral means something which you give on the basis of which you get a loan. So let's say if I'm going to a bank, I pledge my securities, I pledge my gold with the bank, and I tell them that on the basis of my gold, you give me a loan. So that gold which I kept with the bank, as pledged with the bank, that is a collateral. And the difference between the value of the collateral and the value of loan which I get is margin requirement. So let's say I go to the bank to get a loan of 1 lakh rupees. How much gold I need to pledge? Let's say I pledged gold of 1.5 lakh rupees. I got a loan for 1 lakh rupees. So how much is the margin requirement? Margin requirement is 0.5 lakhs. That is 50,000 rupees. Now, if margin requirement goes up, RBI says that you need to keep more gold with us in order to secure 1 lakh rupees loan. Let's say the RBI says that you need to keep 2 lakh rupees worth of gold to secure 1 lakh rupees as loan. That means margin requirement is going up. If margin requirement increases, the ability of the public to take credit easily goes down. And this will happen in which case? If the RBI wants to control high levels of inflation. When there is high level of inflation, people are having a lot of money. Central bank wants people to have less money so that inflation should be controlled. In that case, they will increase the margin requirement. But if they want people to have more money, if there is less level of inflation, they will reduce the margin requirement. That is how margin requirement works. Now, there is one more thing, that is credit control, which is by providing credit to only selective countries and limiting credit to other countries. So if credit is limited to some countries, inflation will be combated. Inflation will be controlled. And if credit is given more to some industries, inflation level will go high in that industry. Because I told you, money supply and inflation level are very closely related. If there is more money with the public, inflation levels are bound to go up. And the last part of this qualitative instrument, moral persuasion, so to say, that means persuading or instructing the commercial banks in order to obey the policies of RBI. So let's say in the time of inflation being very high, RBI does not resort to other measures. RBI just nudges the commercial banks and tells them and persuades them that you please obey and please you follow the respective measures in order to control inflation. That is moral suasion or moral persuasion. So with these two methods, through quantitative and qualitative measures, RBI is able to again control inflation levels and put inflation under that bandwidth, under that band level. So now we have understood both fiscal policy and both monetary policy and how both are aiming to ensure that inflation in the country is controlled. If inflation in the country is controlled, eventually other economic indicators will fall into place. And if you have closely noticed, the motive of each of fiscal policy and monetary policy was to ensure that liquidity is controlled in order to control inflation. That if you control the money supply, inflation will be controlled. If inflation is very high, you reduce the money supply. If inflation is very less, you increase the money supply to combat it. Basically, that is the whole rationale which we are talking about. And to ensure there is a smooth functioning of all these policies, the government of India has come up with a monetary policy committee also. So basically, there has been introduction of inflation targeting framework into our economic system as well. Inflation targeting simply means adjusting the monetary policy to achieve specific rate of inflation in the country. And it was first done in New Zealand in 1990 and eventually replicated by other countries thereafter. And in India, it was on March of 2015 when RBI adopted inflation targeting as its monetary policy framework. And on 2016, what was done was Section 45ZB was added to the RBI Act of 1934 and RBI Act of 1934 was amended. So Section 45ZA and Section 45ZB were added to ensure this inflation targeting and was added to the RBI Act of 1934. And the aim was simple, to maintain price stability and to keep inflation levels under a certain prescribed bandwidth. And of course, it was recommended by a committee chaired by Urjit Patel. That is Urjit Patel Committee. And there would be in total of 6 members of this monetary policy committee. And these 6 members will determine the policy rate which will eventually achieve the target of inflation in the country. So who are the 6 members? The ex officio chairman is of course the RBI governor. Then the deputy governor is also a member who is in charge of the monetary policy. Then third member is the officer of the bank which is nominated by the RBI board. Then there are other 3 members which are nominated by the government. So both government and RBI's representation is there in the monetary policy committee. And the quorum is 4 members. That is, if 4 members or less are there, that means lesser than 4 members are there, then the meeting of monetary policy committee cannot convene. And they meet at least 4 times a year. So at least in 1 quarter they have to meet once. And in the meetings, the decision is taken by majority. And if there is a tie, then the governor is having a casting vote or a second vote as well. Now your question would be that what is the inflation target? It is the same as what I have been repeating in the initial parts of the lecture. It is 4% plus minus 2%. That means from 2% to 6% is the inflation target for our country. That means if inflation in our country remains in this level between 2 to 6%, that is considered as healthy level of inflation. If it goes below this, that is not good. If it goes beyond 6%, then also that is not good for the economy. And every 5 years, this target is renewed and reviewed. And for the current time, that is from 2021 to 2026, we are having this target that is 4% plus minus 2%. Now the question would be, what if RBI fails to meet this target? Now in the case if RBI fails to meet the target, they have to send a report to the central government. And that report would be primarily highlighting three things. First would definitely be the reason of failure. Second would be the remedial actions which are proposed by the RBI. And third would be the estimate time which is required to achieve this particular target. See, all these things needs to be mentioned in the report which is set out to the central government by the Reserve Bank of India. Now, there have been instances in the past where inflation target has not been met. And more so, inflation has gone beyond that 6% mark. In that case, what happens? Central bank sends report to the central government, but remedial measures are also taken. And what kind of remedial measures? Whatever we saw in the monetary policy. And in certain cases, government also intervenes through fiscal policy. Now, I hope all the things, that is what is inflation, why inflation is there, is inflation good or bad, how to control inflation, and what percentage of inflation is good for the economy are very clear for all of you. Now, inflation is a very necessary evil, because if inflation is not there, then there is no growth. If prices are not increasing, wages will not increase. And with this, I will just introduce one small concept and then we'll end the session. One concept is related to wage price spiral. Now, you must have observed one very interesting thing. A lot of organizations, they increase the wages of their employees with respect to increase in the price levels in the economy. So basically, it is safe to say that wages are adjusted with respect to inflation levels in the economy. That happens. Central government also does it in the form of dearness allowance. Dearness allowance gets changed because of increase in prices of goods and services. That means inflation. So wages are increasing when prices are increasing. But if you observe very closely, increase in wages means more money with the public. More money with the public means more purchasing power of the public. That means people would be willing to pay more price for the product and people would be demanding more. And you know what happens when demand is more? There is demand pull inflation. So people are having more wages. Because of that, in turn, there is increase in price of goods and services. So we are seeing a perennial spiral which goes on and on. And this has been ongoing in our economy since the starting point, since 1947. That means wages increase because price increase. And once wages increases, because of that, price again eventually goes up. And because price eventually goes up, next year again wages are revised. And once again when wages increase, again the consumption increases, the spending increases. Because of that, the prices again goes up. And because of that, again wages are revised. So what are we seeing? We are seeing a wage price spiral which goes on and on. Until what point it will go on, no one knows. Because as long as the economy remains, this inflation or price wage spiral will prolong. I hope you gained a new perspective from this session. Now, how to control inflation and what other measures can be performed in order to tackle this inflation and put inflation under the controlled manner. Whatever the suggestions you are having, please let me know in the comment section. All the very best. Have a beautiful day. Thank you.